Hey guys, this is Scott Horne, and we're going to talk a little bit about the loan process and just really mistakes to avoid or how to get prepared for it. If you like the video, take a minute and like it. We'll look forward to seeing whatever comments you might have and try to answer those as well. And don't forget to take a moment and subscribe to our YouTube channel. Now, loan processing is important. This is the application process for your loan. And there is just basic information you need to know before you walk out the front door to go meet a loan company or your loan officer. And it doesn't necessarily matter whether this is a traditional mortgage or a DSCR type loan or even a hard money loan of that regard. Some of the basics are all important. And so, number one, in the traditional mortgage world, credit is number one. I find it really intriguing about the mortgage world that they want you to have credit. They want you to use a credit card. They want to see a reoccurring payment all the time, that you have the ability to do that on a constant basis. On the flip side, I look at some of the transactions I do in the creative finance world where my borrowers have zero credit. They have no debt. They have nothing. They have no history at all. But the fact that they have no debt, they pay for everything, they own everything free and clear, I look at that and go, that's A+ credit in my world. But the mortgage world actually calls that C credit. So if you're going after that traditional mortgage loan, that DSCR loan, credit is number one most important. And especially if you're young in this business, do whatever you can do to maintain that and don't destroy it, because it can be huge in factoring the cost and expense of your mortgage, your car, and everything else involved in your life. So once you do get past the credit, it's learning what financial information do you need to be able to provide to a lender. Obviously, these guys are going to want to see where you live, how long you've been there, what you've been paying. It shows a consistent history of payment. They're going to want to see, where do you work? What do you make? How long have you been there? You know, do you job hop every 3 months, or are you at a place with consistency? Again, lenders like consistency that are out there. They want to know what your total income is. Also, what are your monthly reoccurring expenses, so they can see what your legitimate net monthly income is, so they know exactly how much to apply or what you can apply to the loan that you are applying for. Now, from there, they're going to ask other basic questions on an application, and you can go look up online very easily a 1003 application. That's a 1003 application. And I like telling investors and students all the time that do not call it 1003, because you will sound like a flat out rookie. If you want to be cool and get the lingo, it's a 1003 application. And this is a standard Fannie Mae application that is used throughout the country. And you can read through there what they're asking for. So when you're going to go in and meet with that loan processor, be prepared to fill that out properly. Have that information with you along the way. Understand that they're going to ask for your last 2 years' tax returns. If you're a W-2 employee, they want to see your last 2 years' W-2 statements. If you're a 1099 employee, same thing. They want to see your 1099s. They want to see the evidence of the income that you're claiming you make. Now, along the way, when they pull your credit report, they're going to see all the bills you're paying and the credit that you've applied for and things of that nature along the way. So they don't necessarily ask for that on your credit application, because they're going to pull that up individually. But keep in mind that the two most important things in the loan processing world is ensuring you have good credit and ensuring you know what information you need to provide to them. Now guys, so often, especially in the self-employment world, it's a double-edged sword. People who are self-employed want to write off everything to reduce their income, which does what? It reduces their income taxes they have to pay. Well, on the flip side, by reducing your income, it also reduces your ability to get a loan in many cases, because you're not demonstrating sufficient income, which is what your lenders always want to see. Now, from there, when you go into loan processing, you need to have an idea of what type of a loan is it you're asking for. Is it a 30-year fixed rate mortgage that's fully amortized, 20-year, 15-year, 10-year? What is it? Have you researched what the interest rates are? Because the lower your amortization period, your interest rates go down occasionally. Maybe even the fees go down. You don't want to call just one lender, but you kind of want to shop around a little bit and talk with 2 or 3 different lenders and get a flavor for what's out in the marketplace. There are subtle differences between lenders. One lender may have more points than the other. One may have more or less fees than the other. And all this means money out of your pocket or in your pocket one way or the other. So get an idea of the kind of loan you want. Can you make extra payments on your mortgage? In most cases, the answer is yes. What if you pay your loan off early? Is there a prepayment penalty? Just having this modicum of knowledge of questions to ask your lender is all important along the way. Look at the overall cost of your transaction. It's the interest rate, how much interest are you going to pay over the life of your loan versus loan 1, 2, or 3. And then I love to tell people to go out and run an amortization schedule that you can look up online in a heartbeat and plug your numbers in. See what happens with that amortization schedule if you make a extra $50 a month payment, $100 a month payment, $500 a month payment, and watch how huge that interest number shrinks over time and how more rapidly you pay off that loan. And guys, you get more bang for your buck if you start doing that immediately from day one instead of waiting, let's say, 5 or 10 years down the road. Learning how to be financially savvy and smart is so important in the financial world and in the loan processing world. It will empower you as you talk to your loan processor, to your loan officer, so that you have a reasonable idea of what you're looking to obtain, and it gives you the ability to shop that loan properly. When you blend all this together, when you have a good credit score, you know what type of financial information to bring to the table, you know how to put together a financial statement, let's say for a small commercial bank, it will help you immensely because now you're demonstrating a wisdom in the financial world that lenders are looking for. How do you handle your financial affairs is so important, both to a traditional mortgage, to a commercial lender, a DSCR lender, even to a hard money lender who normally looks only at the asset itself and maybe your ability to handle that asset along the way. When you combine all these together, I think it'll help you walk through the loan processing process easier. It'll help you to negotiate the vehicle you're looking for to buy that next real estate asset. So guys, I hope you found this helpful. If you did, take a minute and like us. Don't forget to comment below, and don't forget to subscribe to our YouTube channel as well. And we'll see you all next time.